Understanding basis points, volatility, recession, and sentiments. A simple guide to explaining basis points and key concepts. Basis points. Definition of basis points. A basis point is a unit of measurement used in finance to describe the percentage change in the value of a financial instrument, usually a bond. It is important in understanding how the market behaves. Example of basis point. If the interest rate of a bond changes by 50 basis points, it means that the interest rate has increased or decreased by 0.5%. This can have a significant impact on the value of the bond. Basis points versus percentage points. Basis points are a measure of change in interest rates or bond yields that represent 100th of 1%. An increase of 50 basis points represents a change of 0.5%. Percentage points. Percentage points are a measure of change in interest rates or other percentages. 1 percentage point represents a change of 100 basis points. An increase of 1 percentage point represents a change of 100 basis points. Calculation and comparison of basis points with percentage points. Basis points to percentage points conversion. To convert basis points to percentage points, divide the number of basis points by 100. For example, 50 basis points is equal to 0.5%. Percentage points to basis points conversion. To convert percentage points to basis points, multiply the percentage by 100. For example, 2.5% is equal to 250 basis points. Examples of basis points in finance. Basis points in interest rates. Basis points are used to measure changes in interest rates. For example, if the Federal Reserve raises rates by 25 basis points, it means that the interest rate has increased by 0.25%. Basis points in bond yields. Basis points are used to measure changes in bond yields. For example, if a bond yield is 150 basis points above the benchmark rate, it means that the yield is 1.50% higher than the benchmark rate. Mortgage interest rates. Basis points. Basis points are used to describe changes in mortgage interest rates, where each basis point represents 100th of a percentage point. Prime rate. Prime rate is the interest rate that commercial banks charge their most credit-worthy customers. Mortgage interest rates are often quoted as a certain number of basis points above the prime rate. Mortgage interest rates. Mortgage interest rates are the rates at which banks offer home loans to borrowers. They are often quoted as a certain number of basis points above the prime rate. Bond yields. What are bond basis points and bond yields? Basis points are used to measure small changes in the yield of a bond, generally in hundredths of a percentage point. How do you calculate bond yield? Bond yield is calculated as the annual interest payment divided by the bond's price. It is expressed as a percentage. How are bond yields affected by interest rates? Bond yields are inversely related to interest rates. When interest rates rise, bond yields fall, and when interest rates fall, bond yields rise. Partial rebound. Definition of partial rebound. A partial rebound is a slight increase in the value of a market index or security after a significant decline. It is a sign of market improvement, but not a complete recovery. Implications of partial rebound. Partial rebound indicates early stages of market recovery, but it is not a guarantee that the market will fully recover. Investors should exercise caution and be prepared for further market fluctuations. Market weakness. Market weakness refers to a decline in the value of a market index or security. It is the opposite of market strength and can lead to increased volatility in the market. Volatility. Volatility is a measure of the degree of variation in the price of a market index or security over time. Market weakness can lead to increased volatility in the market. Volatility. Volatility is a measure of the amount and speed of price change for a financial instrument, caused by various factors such as economic or political events, and can lead to market instability. Volatility as an advantage. Investors can use volatility to their advantage by buying low and selling high, but it can also be risky. Recession. Definition of recession. A recession is a significant decline in economic activity that lasts for more than a few months. It is characterized by a decrease in gross domestic product (GDP), high unemployment rates, and low consumer spending. Impact of recession on financial markets. Recession can have a significant impact on financial markets, leading to market weakness and decrease in investors' confidence. Market sentiment. Bullish market sentiment. Bullish market sentiment refers to an optimistic investor's attitude towards the market, with expectations of growth and rising prices. Bearish market sentiment. Bearish market sentiment refers to a pessimistic investor's attitude towards the market, with expectations of decline and falling prices. Bearish sentiment. Definition of bearish sentiment. Bearish sentiment is a belief among investors that the market or a particular security is going to decrease in value, leading to selling activity and a decrease in prices. Impact of bearish sentiment. Bearish sentiment can have a significant impact on the market or a particular security. It can lead to a decrease in prices, increased selling activity, and a loss of investor confidence. Bullish sentiment. Bullish sentiment is a term used to describe the general attitude of investors who believe that the market or a particular security is likely to increase in value, leading to buying activity and an increase in prices. Conclusion. Market rebound and weakness. Understanding market rebound and weakness is crucial for investors as it enables them to make informed decisions and minimize risks. Sentiment analysis. Sentiment analysis is a useful tool for understanding the market's mood and predicting future trends. Basis points and related terms. Understanding basis points and related terms is essential for investors to better understand how the financial market works. Thank you.